Hi, I'm Casey,
And I'm Taylor.
and we're here with Cadent Capital's Economic Outlook, and we're doing so during a season of change for the economic landscape.
We're coming to you on the Friday after the election. What we know so far at the time of this recording is that Donald Trump has been reelected. The Republicans have taken control of the Senate and are going to maintain control of the House, we think, but that has not been noted for sure yet. One of the things we feel fairly confident in is that the tax cuts that were enacted in 2017, TCJA, will most likely be extended with the Republicans controlling the House, the Senate, and the presidency. One of the other things that we are now thinking will be more likely extended is the lifetime exemption amount. That currently is at $13.99 million. We expect that will be extended. If you recall, it was going to be cut approximately in half January 1st, 2026, pending any other legislation. We'll see during 2025 if that legislation comes up, and we'll see with the extension of TCJA what form that will be in. We expect there to be some changes, but in all likelihood, the major provisions will be extended.
While it seems obvious that these tax cuts will be extended, the reason for caution, if you have optimism about that, is the Republicans do not have a supermajority, so they do not have filibuster protection. Therefore, tax law change likely will still be a political football, like it always has been.
Yes.
That was probably our most sharp view that came out of the results of the election, that there likely will be extension of tax relief. There was an immediate reaction within the markets that we thought was notable, and that was commodity prices softening. I don't know that that was expected. Certainly, we hadn't thought about that as a likely outcome to a high degree. However, it does make sense when we hold it up to a reasonable level of inspection, given the president-elect's stance on being pro-energy and energy being a high cost in the production of other commodities. So if energy prices will face a higher supply, which helps push pressure on prices down, it stands to reason that commodity prices could see relief, be cheaper, and hopefully flow all the way through to the grocery store and restaurant tables. I'll believe that when I see it, but nonetheless, that is relief that many consumers are hoping for. Beyond that, from a portfolio perspective, we're looking at that very opportunistically. Now, President-elect being pro-energy could make investing in energy seem like a good opportunity. However, before there is the ability for energy companies to benefit, they first have to have excess supply, opening up new opportunities, have less regulation, and supply will move much quicker than demand will. So likely downward price pressure, which means investment will likely decline as well, allowing a better entry point than we have today. Fortunately, we extracted ourselves from much of the energy and commodity exposures when they had a strong run-up. So we'll be re-entering at likely a much better price, hopefully over the next year or two.
One thing that we saw after election night was the strengthening of the dollar. However, we don't expect the dollar to stay strengthened. One of the things that President-elect Trump ran on was a weak dollar because he and his administration believe that the U.S. will be better with a weak dollar so that more manufacturing will be brought onshore, so American goods will benefit the economy is their belief. So we'll be watching to see if the dollar weakens during this administration or if it will strengthen like it has previously.
Yes, and we were seeing evidence during President-elect Trump's first term. The dollar was weakening, and then we had something called COVID-19 come out of left field, and then, of course, there was a strong flight to the dollar that we've experienced since. Beyond just the dollar sending some mixed signals here recently, we also are seeing mixed economic signals within inflation, the rate environment, and then also what is expectation about GDP, or the value of all goods and services produced in the U.S. These often fight against each other, especially the rate environment and inflation, but also this changing investing and economic landscape. It's really exacerbated by the pro-business stance of President Trump's platform. It could spur further growth, which makes an argument that we cannot have as an accommodative of a Fed as we are seeing at the moment with 2 rate cuts recently. totaling 0.75%, but also it has the possibility of spurring back inflation.
Right. And one of the things that we think may spur inflation back is tariffs. Companies and countries have said that they are going to pass along any tariffs that are put on by America, and that will lead to higher prices, which leads to increased inflation. So we'll be watching that closely to see if the lowering of inflation that's happened continues at the same rate that it has been.
And further muddying the economic waters here is the possibility, maybe even likelihood, of the creation of the Department of Government Efficiency. This is not known that it will occur, not known what the impact will be, but the focus is spending cuts within government. There's been speculation it could be even up to a third of the government budget. I doubt that we would achieve anything remotely like that, but any meaningful level of spending cuts, while likely good for the government or for the health of the U.S. economy long term, it can affect people in the short term, and certainly it can affect the economy negatively in the short term as well, possibly being a deflationary pressure. So we have this big soup of good and bad factors for the economy that we don't know which will drive the boat yet, and we'll just need to see where these trends emerge.
And what that looks like for you is money markets. There has been a flight to money markets with us, and as we look at that, the mixed economic signals lead us to say, how much do you need to keep in reserves, and how much of that do we want to rotate into short-term fixed income in order to increase yield and possibly price appreciation as rates come down?
Yes.
Because as rates come down, the yield on the money markets is going to go lower, leading us to looking for ways to increase fixed income returns while maintaining emergency reserves at the right level for you.
Yes. Fortunately, despite the Federal Reserve reducing rates twice, market bond rates have lifted, allowing some opportunity to still rotate from money market prudently to that fixed income. And we believe with a very good chance of improving total return expectation over even a short time frame like the next 1 to 2 years. However, if the Federal Reserve continues to lower rates, bond market rates likely will follow at some point. And especially if these mix of economic data lead to a touch of economic weakness in the near term, we probably will erode the opportunity to rotate from money markets to fixed income to improve return. So we're starting to look down the path and say, what gives us the opportunity to take marginal risk and still have attractive, safe returns? And we're specifically exploring private credit with that. It won't be appropriate for everyone. It would not be appropriate for all of our fixed income, but private credit can provide attractive risk and return, higher yield or total return, but comes with some unique trade-offs like illiquidity and a liquidation process that is not overnight. We'll be considering if it's appropriate for you and your portfolio and be in touch over the next 6 months. Just know that's a theme that we're looking at as a likely solution, much like we did over the past 2 to 3 years, rotating from bank balances and CDs to money market.
As always, if you have any questions about your specific planning or portfolio, reach out.
Thank you.